history of credit. The buy now, pay later concept of credit has been around for many, many years. In fact, some believe credit goes back more than 3,000 years, starting with the Egyptians and Babylonians. Believe it or not too long ago, credit information was gathered by the Welcome Wagon representative who would judge you based on things like the quality of your home, your furniture, their opinion of your character, etc. Just in case you don't know, the Welcome Wagon representatives were commercial greeters who would knock on a new neighbor's door to welcome them to the neighborhood. Back then, if you applied for a loan, the lending decisions were made based on what was on your report, which was someone's flawed opinion, and on how the underwriter at the bank felt about you. Yup, their intuitive hunch, another flawed opinion. If you don't look right, or if you were from some minority group or lived in the wrong neighborhood, then your chances of getting credit was slim to none. Around the late 1960s, as credit became more popular, it was impossible for banks to personally interview all applicants or rely solely on the credit reports it was using. At the same time, Congress had begun investigating discrimination cases that included housing loans and the practices of collection agents. Because of this, we saw the birth of 3 federal regulations that would forever impact the credit game. In 1971, we were introduced to the Fair Credit Reporting Act, or FICRA, which tried to make sure that your credit report was accurate, fair, and private. In 1975, we were introduced to the Fair Credit Billing Act, FCBA, which tried to protect consumers from unfair billing practices and to give us, the consumer, a way to address billing errors in our revolving credit accounts. And lastly, in 1977, we were introduced to the Fair Debt Collection Practices Act, or FDCPA, which tried to eliminate abusive practices by debt collectors and aimed to make sure that what was on your credit report was correct. These 3 regulations forced the credit reporting agencies to act in a more fair, respectable, and responsible manner. As the information in a person's credit report became more standardized, credit providers began to rely on them more than on the gut feeling of the underwriter. Lenders started to create their own automated risk scoring systems, but because the results were inconsistent and inaccurate, they continued to look for a system that was more reliable. Enter Bill Fair and Earl Isaac, the founders of the Fair Isaac Company, which is better known as FICO. In 1956, they started FICO as a way to develop and market their credit scoring concept. In the early years, FICO marketed their scoring system to financial services companies that were trying to find a faster and more accurate way to make credit decisions. The breakthrough came during the late 80s as computer software automation became popular with many businesses. In 1989, FICO introduced an automated credit scoring system that was marketed as the impartial, consistent way to evaluate credit application, taking the prejudice and instinct out of the equation. In layman's terms, this was the most accurate, consistent, and fair way to judge someone's creditworthiness. Given that lenders were being put under pressure by Congress to get rid of discriminatory lending practices, FICO seemed to be the best answer to their problem, and the system was quickly embraced by credit card companies and other credit issuers. This was the beginning of FICO's reign as the premier and universally accepted credit scoring system. Then, in 1995, the deal was sealed when top mortgage issuer Fannie Mae and Freddie Mac stipulated that mortgage lenders incorporate the FICO score in their approval process. This is why today, the FICO score is the most important score as it relates to your credit. FICO isn't the only game in town, though. In fact, on the market, there are hundreds of other scores sold by the credit bureaus to lenders, insurance companies, credit card companies, landlords, financial companies, telephone companies, and any other entity that needs your information for sales or marketing purposes. Despite all of the competition, and for now, the FICO score continues to be the clear leader and the score that matters most, as it is currently used by 90% of major lenders. A fun fact is that in 2006, VantageScore was created in collaborations with the three big credit bureaus, TransUnion, Equifax, and Experian, in a concerted effort to overtake FICO's lead in the market. VantageScore became a new generic but exclusive credit score model marketed as a more consistent interpretation and accurate score than FICO. Companies like Credit Karma, who give you a free credit score, are giving you your Vantage score and not your FICO. But the same steps that it takes to properly manage your FICO score are the same steps needed for Vantage and most of the other scores. So basically, if you understand FICO, you'll understand the rest. Your credit score is broken down into two parts. One, your credit report, and two, your credit score. Items included in your credit score: information that identifies you, your name, social security number, address, date of birth, and the name of your employer. Most of this information is supplied by you when you fill out a credit application. Trade lines: a history of your current credit obligations, which include all of your credit cards and other accounts, the date that you opened them, your credit limit, your high balance, the highest amount you have owed on the account to date, the current balance, your payment history, etc. Credit inquiries: voluntary and involuntary inquiries, including account review inquiries from current lenders, hard inquiries from new loans or credit applications, and promotional inquiries from credit card companies and other solicitation offers. Public record: any bankruptcies, foreclosures, wage garnishments, liens, and judgments. Collection accounts: your delinquent accounts that have been placed in collection status by a creditor or collection agency. Delinquent accounts for anything from a phone bill to a credit card or a medical bill are payments that are several months late. Items that are not included in your credit score. Although this information may appear on your credit report, it is not taken into consideration for your credit score. Age, race, color, religion, nationality, sex, or marital status, occupation, salary, employer, length of time employed, where you live, interest rates charged to you on credit cards or other accounts, any item reported as child support or rental history, certain types of inquiries such as consumer-initiated inquiries or promotional inquiries.